meaning if you take everything on the Fed's balance sheet, including all the debt that it has, and then you take the gold part of the balance sheet and you make it balance out the debt, meaning if the debt disappears, you still have that same value in dollars in the gold, or purchasing power in the gold, then that balances the balance sheet. That's what it's supposed to do. So I think we're still at like 7-8%. We're nowhere near the limit. I think the limit would be if we're going to have the 1980 numbers of 130%, which we had for one day. I don't expect that. That's not equilibrium. That's not going to be sustained. But 130% would be like $90,000 an ounce, which we could get if the Fed completely stops printing.
After holding initial support at $3,000 an ounce, gold's rally continues unabated, closing the week at another record high and moving within striking distance of $3,100. While momentum indicators suggest increasingly overbought conditions, analysts emphasize the market's strong fundamental support. Gold is currently trading at $3,077.30 an ounce, up 0.68% on the day, and is set to end the week with a nearly 2% gain. Friday also marked the conclusion of the last whole trading week of the month and the quarter, with gold prices climbing roughly 8% in March and on track to post a 17% gain for the quarter. This upward trajectory has reinforced gold's role as a hedge against inflation and currency devaluation, attracting investors seeking stability in a volatile economic landscape. While some attribute the latest price surge to short-term geopolitical developments and economic policy shifts, Rafi Farber of the Endgame Investor dismisses such explanations, instead highlighting the fundamental role of gold and silver as money. Over time, these metals serve as a counterbalance to the Federal Reserve's liabilities, preserving value as the purchasing power of fiat currency declines. This dynamic continues to unfold, with gold setting new all-time highs. Looking ahead, analysts point to $3,100 as a crucial level that could indicate a near-term peak. However, according to Rafi, beyond short-term technical movements, a key indicator remains the gold-to-silver ratio, which currently hovers around 88 to 90. Historically, a significant compression of this ratio, moving toward 15 to 1, has signaled major financial shifts. If gold reaches $3,500, a gold-to-silver ratio of 70 to 1 would push silver prices to $50 an ounce. With the current ratio at 87 to 1, silver may be poised for a sharper upward move as the market adjusts. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
I don't think we're testing any limits. I mean, the limits, the actual limit would be the 1980 limit taken by the Daniel Oliver calculation of if you take the market price of gold and you multiply by the amount of gold that's supposedly represented by the Fed's gold certificates, how much of those, if you take the total dollar amount of that, what percentage of the Fed's other liabilities is back? And the peak in 1980 was 130%, that was too much. That's why gold fell after that. That's functionally a gold standard, meaning if you take everything on the Fed's balance sheet, including all the debt that it has, and then you take the gold part of the balance sheet and you make it balance out the debt, meaning if the debt disappears, you still have that same value in dollars in the gold, or purchasing power in the gold, then that balances the balance sheet. That's what it's supposed to do. So I think we're still at like 7-8%. We're nowhere near the limit. I think the limit would be if we're going to have the 1980 numbers of 130%, which we had for one day. I don't expect that. That's not equilibrium. That's not going to be sustained. But 130% would be like $90,000 an ounce, which we could get if the Fed completely stops printing. And then a banking crisis ensues, right? And then we get to 130%. That could last for a day. We could hit 100% for maybe a month or two until a new derivative system crops up and then replaces the old debt with a new debt, some kind of haircut system or something like they did in Europe during the sovereign debt crisis. Something that could happen. But yeah, 3,060, it's nowhere near any kind of limit. What's causing it? This is always a fun game. You could always try to point to the proximal cause. Yeah, I think it's this, I think it's that. I think the mainstream media is saying that it's the tariff threats and Trump is threatening tariffs on this, tariffs on that, and breaking down international trade. The proximate cause doesn't really matter. I'm sure there's a more correct answer and a less correct answer, but the beauty of understanding that gold and silver are money is that it doesn't matter. I mean, and then once you know that the end game is that gold and silver will balance out the rest of the Fed's liabilities, meaning all the purchasing power will go into the debt. As the debt loses value, gold and silver will gain value. Gold will gain value because it's on the balance sheet and because that is the money. Silver will gain value if the gold derivatives no longer work, because if the gold derivatives no longer work, there's no other way to divide silver. set to divide gold, and that's why silver will go up. So it's nice that gold's going to 3060 because I want this whole thing to end as soon as possible, just so society can move on. But the sign that we're really close is going to be the gold to silver ratio, which hasn't really moved down. By down, I mean silver moving up. I think we're still at like 88, 90 or something. I haven't checked it in a while, but it's nowhere near any kind of end game territory. But I do believe that when we start to move down to the 15-to-1 ratio or towards that area, it's going to be fast. In 1971, I think the total amount of time that silver was actually moving up in the 1979-1980 era, and that was most of the move. I think it was a total of 4 months, right? Excluding the parts of 1979 where the gold to silver ratio was stable, which was like 2 or 3 months in that year. So I think the whole thing was like 4 months. So we're going to see a move of about, from 90 to somewhere around 15-to-1. And when we start to see that move, it's going to be really fast. I don't know when it's going to start, but once it gets going, we're going to get there quick. There's not going to be time.
Gold prices have historically shown a tendency to rise in the lead-up to financial crises, a pattern observed before both the 2008 financial collapse and the 2020 market turmoil. According to Rafi Farber of the Endgame Investor, a strengthening U.S. dollar during times of crisis creates pressure to secure reserve assets, driving gold into the financial system as a hedge against uncertainty. This safe haven demand has been a consistent factor in gold's price movements, with investors seeking protection in response to significant economic and geopolitical shocks. Past events highlight this trend. Investors flocked to gold following the September 11, 2001 terrorist attacks, at the onset of the global financial crisis in 2008, and again during the outbreak of COVID-19 in 2020. Similarly, Russia's invasion of Ukraine in February 2022 and the subsequent sanctions, including the freezing of Russia's foreign government bond holdings abroad, exposed the risks associated with relying on foreign currency reserves. The response from governments and central banks was notable, as many increased their gold purchases to mitigate geopolitical and economic risks. Central banks recorded record gold purchases of 1,082 tons in 2022, followed by 1,051 tons in 2023 and 1,041 tons in 2024. This ongoing accumulation underscores the importance of gold in maintaining global financial stability and its appeal as a strategic reserve asset amid economic and geopolitical uncertainties. Let's get back to the interview.
If I'm a foreign central bank and my assets are mainly dollars, right, and my currency is weakening, then I would, or let's say if you're a foreign central bank and you're relying on the dollar system, then let's say you're in a currency crisis, and then in a banking crisis, then what you're going to do is you're going to try to weaken your currency to keep your banking system alive. So you'll buy more of your reserve, you'll buy more dollars. I remember the Bank of Israel doing that here when the shekel was strengthening. They bought more dollars. I think it was because of the war, other things like that. So when you are the reserve currency and your currency is strengthening, right? To weaken it, what else can you do but buy your reserve? If you're the reserve currency, you can't have other currencies in reserve. I mean, you can technically, but they're not gonna. That's folding back in on itself. Like you have to go down a layer. So your reserve is going to be gold. So you could say that the central bank or its proxies or something or some other bank that it's controlling is buying gold in order to preserve its own banking system, because there's nowhere else to go in the pyramid. So that would be if the reserve currency is under attack, meaning its banking system is under attack, meaning the currency strengthens because there's a dollar shortage or some kind of financial crisis brewing that we don't quite see yet out in the open, but it's happening. Again, like remember, like before the 2008 crisis, gold was going up and up and up and up for like 6 years, right? It wasn't stopping. And before the 2020 crisis, it was also going up, and then it spiked at the end of the crisis. So we're seeing that now. So this means like this is the early innings of a financial crisis. When there's a financial crisis, the dollar goes up in value as huge demand in a liquidity crisis, liquidity crunch. And so the mechanical response is to acquire more of the reserve asset with the dollars by creating more dollars to buy that reserve asset. I would say directly, I'm not saying the Fed's printing money to buy gold, but I'm saying this is, it happens in more of an organic way that I can't really explain, but it's happening now because you're seeing the flows. I mean, we're not making these things up. So that's what I think's happening. I think we're at a strengthening banking crisis or financial crisis or some kind of crisis that involves the dollar strengthening, and that's why gold is flowing in. Obviously, you want to have physical gold and silver. You want to have some physically with you that you can hold on to and use in a pinch. I wouldn't hold all of it at home because there is a risk to that. So keep it with a company that you trust, that you know is philosophically with you. I use monetary metals. Maybe you do too. You can buy some from Miles Franklin, who you affiliate with. I highly recommend that also. And maybe gold stocks you could also own, though those are also risky. So you want to kind of mix it up. And junk silver is definitely very important. And maybe even more important than that, after you have a minimal amount of gold and silver, is you need to be around people who don't have to understand the monetary system, but they have to have a basic sense for what reality is. Right? They have to have a sense that gold and silver are kind of a good idea to have, and that people with basic morals, people you can talk to that aren't completely nuts, and that will ground you mentally, and it will keep you from panicking when things are really falling apart. To have a community of people that have resources and talent, and they can farm, and they can grow food, and they're armed, and they can protect from roving bands of whoever's going to come, get out of the big cities. And then I would say to get through it, when we hit a 15-to-1 ratio, when the gold to silver ratio hits that number, that's the bell. It's not going to get any worse than that. When we hit that ratio, it's going to be peak chaos. So your responsibility at that time is to go out and buy anything that you can, because by buying stuff, you are circulating gold and silver throughout the economy, and that is what will stabilize things. People need money to survive. If the dollar is not money, they need money. They need something that is stable. So they're going to need gold and silver. That's why they're offering all their stuff to you at a 15-to-1 ratio at very, very low prices, because money is the most basic good that is in most desperate need. Because it's not like we run out of water. It's not like we run out of food. It's not like we run out of housing. It's that we have no monetary medium with which to distribute this stuff anymore. And that causes the crisis. So the more we get gold and silver out into the open at that 15-to-1 ratio or somewhere around it, the quicker we can get out of this crisis. So that's what you got to do.
Gold's relentless climb reinforces its role as a safeguard against economic instability and currency depreciation. With central banks steadily accumulating reserves and investors seeking protection from financial uncertainty, the metal's appeal remains stronger than ever. As markets anticipate the next major shift, gold's trajectory could signal more profound changes in the global monetary landscape. Could the sustained demand for gold signal a broader shift in how nations and institutions approach financial security? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.